Live from Singapore, this is Inside with Haslinda Amin, where we dive deeper into the stories that matter with crucial context and sharp analysis. Oil prices extending declines and hopes for a breakthrough on energy flows through the Strait of Hormuz. Iran and Oman discuss a temporary corridor and mine clearing operations with a view to a more permanent agreement. The drop in oil lifting Asian bonds and stocks as inflation fears ease. Nvidia's earnings out later Wednesday, set to be the next major catalyst for markets and the AI trade. We'll get the macro outlook with HSBC Global Chief Economist Janet Henry, who sees inflation risks still skewed to the upside. And as foreign investors help Thailand's equities rally, we speak to the stock exchange president Asadej Kongsiri about what's luring international buyers back. Our top story today, oil prices falling for a third day amid renewed hopes for the resumption of shipping in the Strait of Hormuz. Iran and Oman say they have discussed a temporary joint maritime corridor with talks to continue on a permanent arrangement. They're also looking to clear mines to restore safe navigation along the critical waterway. Middle East correspondent Amir Abu Umar joins us now from Dubai. And Amir, where are we with the talks? And why is mine clearance still a focus when Trump has already said the U.S. Navy gas has cleared the strait?
Yeah, good morning, Haslinda. Perhaps I start with the latter part of your question. President Trump had said that the demining process in the Strait of Hormuz had happened, but then again, he provided no evidence to that assertion, and it's not a claim that he hadn't made before, so we've heard that line before. Now, going back to that interim agreement between Oman and Iran, of course, a months-long negotiation that took place between the two countries yesterday in a joint statement. They both said that what is happening in the Strait of Hormuz is essentially a temporary mechanism to reopen or resume shipping through the Strait of Hormuz, to demine it, and then there will be further negotiations, of course, between the two countries to find a more permanent solution over the next 30 to 60 days, in which the two countries are going to discuss multiple things, including the management over the Strait of Hormuz, Haslinda. So that's back to the table. Iran's assertion of dominance over the waterway is still very much a point of discussion, and it doesn't seem to be going away.
Is confidence coming back to the Middle East? We're hearing that the U.S. is restaffing its embassies in the region.
Yeah, this is an NYT article that came out earlier, citing an internal document that suggests that staff in embassies that had left throughout the peak of the war could be coming back to the Middle East. And now why this is important is, of course, because of the suggestion that we might not see a return to military escalations from the U.S. side, at least. And of course, that's been widely reported over the past couple of months or so due to the lack of munition, due to the lack of strategizing by the United States to come back to a full-scale military operation in the Middle East. Now, that is the consensus, that is the assumption, that we're not going to see full-scale warfare, new fronts opening up in the Middle East. But then again, we also have to remember that the U.S. had these economic plans, or the economic isolation plan that was announced by Scott Bessent earlier in the week, of course. And we've discussed multiple times what Iran's retaliation could look like if they are indeed suffocated by these economic measures. Now, we understand that even if those economic measures are implemented, the secondary sanctions, they could take months, if not years, to catch up to the full impact of what they could have in Iran, of course. But if that does happen and Iran decides to retaliate, it's not completely far-fetched, according to a lot of analysts, that Iran could retaliate militarily in countries in the region. But that is, of course, not the base case scenario, and that is why you're seeing energy prices, Brent crude namely, dropping for a third straight day on those breakthrough agreements.
And Aber, what are we looking out for in the coming days, in the coming weeks?
Yeah, so we're looking for wider negotiations to continue to take place. Of course, Haslinda, you know that the negotiations between Iran and the United States have not taken place. Any formal discussions since that MOU was signed in Switzerland, that did not happen. We are also looking forward to more discussions between Oman and Iran about that more permanent solution in the Strait of Hormuz, of course. And then Pakistan's army chief was in Tehran again earlier this week and did say that we might see some fruitful conclusions coming out of that visit soon. So maybe that does allude to some of the wider negotiations that are set to take place between Iran and the United States, but nothing is for sure yet. So a lot of unclarity, but a lot of things to look out for.
Bloomberg Middle East correspondent Aber Abu Omar, thank you so much for that. So how are these developments impacting the macro outlook? Janet Henry is Global Chief Economist at HSBC. Janet, good to have you with us. For all the war talk, for all the elevated oil prices, the global economy seems to be intact. It seems to be resilient. Is that a fair assessment?
Good morning, Haslinda. It's a pleasure to be here. You're absolutely right. And to some extent, this has been a familiar story over the course of the last year or two. Something big happens. We could even go back to Liberation Day, and everyone busily starts downgrading their expectations, but then something changes and the tariffs get scaled back and the global economy tends to continuing muddling through. And certainly we have seen that ongoing resilience over the course of the last few months. In fact, we've even seen it in Europe. You know, we recently had the upside surprise to German GDP growth, which has been very much the sick man of Europe recently. Admittedly, growth is still sluggish in a lot of regions of the world, but relative to expectations, it has not been as bad.
It's okay until it's not, right, Janet? I mean, we take a look at the energy market.
Yep.
I mean, crude seems okay, but diesel isn't. We're already seeing cracks. So that diversion, that K-shaped everywhere, whether it's in the commodities, energy, and the markets. I'm just wondering how you're assessing the risk.
Well, I think your reporter summarised it beautifully. There is so much going on. You know, just to mention some of the things she was talking about, we do not know what the passage through the Strait of Hormuz is going to look like over the course of the next few months, or indeed over the course of the next couple of years. We do not know what the permanent arrangement is going to be. We can talk about all the other factors regarding El Nino and food prices. We've had more tariffs out of Canada. There is a lot that can go wrong, but the pattern has been over the course of the last few months, which is what markets have been so focused on, that growth has so far been resilient, which is why they are looking at some of the possible upside risks as well and waiting to see evidence of how it impacts on the economy in terms of growth and inflation and what that means for policy. But you're absolutely right. What does it do? You know, it's okay until it's not. And these moves that we're seeing in markets, whether it's on bond yields or on currencies or the policy responses that come through, will impact differently on different parts of the economy, whether it's the high-end consumer versus the lowest-end consumer, whether it's manufacturing, whether it's services, whether it's AI and other parts of the economy. Those Ks, as you say, are very much in place and in terms of the outlook are likely to remain so.
And of course, the biggest economy in the world is now struggling with $4 trillion in debt. I mean, it is just kicking the can down the road. At some point, mortgages will become an issue for the Americans. At some point, consumption will be hit if those yields continue to stay elevated.
Yes, the level of yields at the moment are uncharacteristically high relative to what we've seen over the course of the last couple of decades, relative to what we saw before that, relative to, for instance, nominal GDP growth. It's not unusual, but it is on an unsustainable trajectory. We heard this from Jerome Powell for a long time. We heard it from Janet Yellen previously. I don't think we're going to be hearing such explicit terms about the fiscal dynamics being on an unsustainable path in the US from Kevin Warsh when his time comes. But the debt levels are extremely high. And when you have got full employment in the economy and you're still running a budget deficit of 6% of GDP and your debt to GDP ratio ratio is over 100% of GDP. That is a massive burden on the economy. But the point in terms of what it means for mortgages and for the housing market, we've got to remember in the US, if you are a home owner and you've got your 20 or 30-year fixed rate mortgage, you're not remortgaging it on a weekly basis. It's stopping you moving house because you can't take your mortgage with you, which is why we've got such a low level of housing-related activity in the US economy at the moment. But, you know, existing home sales, new building, we saw had more data yesterday. Actually, these are at COVID-type levels. These haven't recovered. It's not adding to the economy.
But yet enough to worry Scott Bessent that he's willing to take action against it. So what is he really worried about then?
What's he worried about? Well, I mean, he's right to worry about, but I think probably about he's worried about potentially the level of yields, because if he's going to be financing the debt at these high level of yields, that means even more goes towards interest payments. And if interest payments are already accounting for about 20% of tax revenues, then absolutely that's on an unsustainable path. But to some extent, that's caused some nervousness that actually even this level of yields, which is not, you know, Greek-type levels or emerging market type of levels that we've seen in the past, that they are already very uncomfortable and very nervous with those levels, which is why, you know, you did see the impact in terms of the dollar weakness that came through. But at the moment, the numbers are actually, as we all know, quite small. We look at the projected level of buybacks relative to issuance, relative to debt, it's quite small. So those buybacks, they can change, but at the moment we know that they are quite small, which is why the markets are not convinced.
So the US economy is in a comfortable position. The Chinese economy isn't so. The latest data shows that, you know, it is weakening further, and the housing market still in the doldrums. How are you assessing the Chinese economy?
Well, not all parts of the US economy are doing just fine. GDP is holding up, domestic demand is strong, but you have got a divergence, and actually some of the consumer data in the US has been a bit softer. In terms of the Chinese economy, then it's quite clear that the growth data has decelerated more than I think the authorities had anticipated, and many markets are actually anticipated. But, you know, we get back to the K-shaped stories. We've absolutely got a K-shaped story in China, particularly in many areas of services and consumer services. We've got a very goods-driven, high-tech goods-driven export story. Exports obviously extremely strong, even most recently to the US over the course of the last few months. So you have got a very divergent economy within China. It's very different to the US, because in China savings rates are very high, and in the US consumers, you know, have resumed lowering their household savings rates, because you have got that uncertainty in terms of consumer confidence and in terms of employment prospects. So I think the other issue with China is the policy response. You know, we do expect further policy easing in China, but it does need to be a bit more focused towards service sector related consumer spending, because on goods, Chinese consumers do not significantly underspend. So the policy needs to be much more targeted in a way that will support the weaker parts of the economy.
But what exactly does China need to do to reverse that weakening economy?
Well, China needs to, as I say,
tried.
It's tried, and I think also potentially they have learned from policy responses elsewhere in the world. If you look at what happened, for instance, in COVID, in a lot of the advanced economies, it was massive support across the board. It wasn't necessarily targeted. So I think some of the policies that have been announced by China over the course of the last couple of years, they've been smaller than I think they probably should have been, but they are being a bit more targeted towards the lower earners and the people that are most needy. We've even seen this in certain areas of the housing market where there is obviously oversupply, and it's been, let's try and make these houses available for rent or for sale to lower income households. Similarly with certain areas of the social safety net, and there are also areas to do with deregulation and tax advantages you can do to support other areas of investment spending. And also, what we do have in China is still this urbanization passage that we've got it all tied up with the hukou system, but also in terms of when people do not have employment prospects in the cities, they go back to the rural areas. So you've got a big part of the rural income that we don't necessarily capture as much in the data.
And Jen, for the rest of the region, for the rest of Asia, it's been pretty resilient as well. And that weakening dollar, which is expected to weaken even further, is helpful.
It certainly is helpful from a policy perspective, but on the rest of the region, you have got a lot of different country stories, as I'm sure you are aware. It looks like obviously you've got the likes of Korea and Taiwan, where you've got without doubt K-shaped recoveries, and now they're thinking about, well, how do they get the tax revenues from these AI companies and use that to support the stimulus to support a broader consumer recovery. Some parts of the region, growth has been a lot more sluggish in the likes of Thailand, for instance, and then Malaysia is an economy where we've continued to revise up the growth, and relative to expectations, India has been somewhat more resilient than many had feared. Again, there are a lot of risks to do with El Nino and high temperatures and what it might mean for inflation next year, but the service sector, the economy, quite a nice contrast with what's happening in China. In India, the manufacturing side really quite weak, trade deficit on goods, but service sector, whether it's consumers, financial services or exports, have been carrying the economy through.
You hear the alphabet K a lot, and I think we have to pay attention to that. Janet, thank you. HSBC Global Chief Economist Janet Henry there. Still ahead on Insight, OpenAI says its new in-house chip outperforms Nvidia's current flagship processor in efficiency. Inside, investors are anxiously awaiting Nvidia's earnings, with the options market anticipating a 4.9% move in either direction after the report. That's over $200 billion in market cap. Markets reporter Anthony Stevens joins us for more. It's going to be really hard for Nvidia to beat expectations, Anthony.
Yeah, it's had a mixed track record on that front as well, right? Like, it's beaten earnings on the last 4 quarters, but it's seen the stock drop on a variety of concerns. And this time we head into earnings with more concerns than usual, right? We have concern around the margin side of things with higher memory costs and higher component costs from Korea and Taiwan. We have concern on the competition side from its clients becoming its newest competitors. Most notably, we have OpenAI coming up with a custom chip very recently, but that follows custom chips from the likes of Google, Amazon and Microsoft. So the competition for custom silicon for inference continues to grow, and how that is going to be addressed in the earnings call is going to be interesting. Meanwhile, the demand for compute has also drawn them into being a kind of a banker for the growth of AI infrastructure in the US. And the CDS market is a little bit more concerned than the equity market around that front. So credit derivatives or CDS on Nvidia has kind of doubled over the last couple of months. That contrasts with a steady drop in implied vol for the stock. So there's quite a dispersed reaction here. Heading into earnings, the equity market is tentative but not that worried. The credit market is looking for more signals.
Well, I'm just wondering whether Nvidia's losing streak has finally ended. I mean, it closed up about 2%. Where do investors see this stock going?
Yeah, that was an interesting one last night. They are also one of the presenters at the Hot Chips conference, and they launched their kind of a grok product to mass production, they said, and they've also lined up some buyers for that chip. So there was some positivity there. There's also some short covering, right? People have to risk manage on both sides going into earnings. So that was some of the dynamic driving that stock yesterday. Now, in terms of investors, if they follow the street, it's only one way. The average price target is around 30% higher than where the stock is. There are not that many sells on the street at all. Out of the 70-odd people covering the stock, there's no sells basically from major houses, just a few holes starting to come through. So in terms of the analyst, it's all positive. Now, in terms of retail, they've really lost interest in the stock. It's lagged the SOX index by something like 50%. So, there's a lot of focus on the stock because it's such a big part of indices. But in terms of the retail and the most kind of risk-seeking investor base, they've moved on.
Anthony, thank you. Bloomberg Markets reporter Anthony Stevens there for us. Meanwhile, OpenAI says its new in-house chip outperformed Nvidia's current flagship processor in key tests measuring efficiency and response speed. Chip chief Richard Ho told us exclusively that the goal is to deliver more intelligence to users at lower costs.
The benchmarks that we did were with an open source kind of benchmark called Inference X. And we did that because it was a fair, kind of neutral benchmarking method. What we're seeing with Jalapeno is that we're able to get both high throughput and low latency with the same device, which is a kind of a first in the industry. And why does this matter is because high throughput means that you can serve a lot of customers with a lot of tokens much cheaper than you could if you otherwise. Low latency gives you very fast response times. And so, the agents will come back faster, you can do, more coding quicker, and that really, I think, is a real benefit for our products.
This is it. This is Jalapeno. You very graciously allowed me to get my hands on it. And again, the whole emphasis is on throughput and ultra low latency. This is an inference chip.
It is.
So very simply, why focus on inference, not on the training side with your custom silicon program?
Well, I think that if you look at it, right, OpenAI has this enormous need of compute. And where that growth of compute is really on the inference side. We need a lot of training, and we have a really strong partner in Nvidia who has, really got a great training chip. So we focused on where we thought we needed to increase the amount of compute that OpenAI has available. With the growth in our users, with our weekly active users growing very, very fast, we saw the need to continue to have a wide range of inference products, and this is going to be part of our fleet along with our existing partners who are providing us other chips.
How do you decide which workload goes to Jalapeno versus Nvidia or Cerebras, for example? You have options, but how do you make that decision?
It's a great question, right? I think with this optionality that we're now creating for the company, I think that we will be able to provide users with a range of models that have different cost benefits and different latency capabilities. We will map that ourselves. We will map out which product, which SKU, which chip is best for which one of these models. But the whole goal of this is to deliver more intelligence to our users at a lower inference cost, at a lower infrastructure cost. And that's what this is part of, that entire strategy that we've been working on for a while now, right?
Lots of people struggle with the benchmarks. To the lay person, it's difficult to decipher. So in very simple terms, on a dollar per token basis, how does Jalapeno stack up against the other options that are out there? How has this changed the economics for you?
It should drop it. It's a really good chip. It should drop it by a lot. The performance per watt that we're seeing, which is a good proxy for how much token will cost, is somewhere in the region between 1.8 to 4x better than other existing chips right now. And so we should see that ultimately when this rolls out into production, customer token prices should come down. That's a big drive that we've had at OpenAI for a little while now. And this really is part of that strategy.
OpenAI chip chief Richard Ho speaking exclusively with Bloomberg Tech anchor Ed Ludlow in San Francisco. Still ahead on Insight, we get the outlook for volatile Indian markets and the rupee with Sid Swaminathan, CEO of JioBlackRock AMC. Keep it here with us. This is Bloomberg. Welcome back. You're watching Insight. India's new closing auction system avoided major disruptions during Tuesday's monthly derivatives expiry, one of the busiest trading days of the month. About 14 billion rupees of shares changed hands in the closing auction, above average levels since the mechanism was introduced. Attention now turns to month end, when MSCI's index rebalance is expected to drive billions of dollars in trading flows. Joining us exclusively, Sid Swaminathan, MD and CEO at JioBlackRock AMC is a 50-50 joint venture between Jio Financial Services, backed by Reliance Industries, and BlackRock, the world's largest asset manager. Sid, good to have you with us. So this new stock auction went without any major glitch. So the coast is clear, you think? No more challenges?
Firstly, Haslinda, thank you for having me. Really, really happy to be here. I think, look, this week and the last few weeks have been a big test. It's fairly new. The market's still kind of getting their head around the auction and how to kind of participate in it. But it's really positive to see the trend, and that's an improving trend. So I think, overall, when I take a step back, a lot of things are now looking good, for India, and that's one of the reasons why we're here with the JV in terms of, when you look at productivity, growth, inflation staying under control. Yes, the last 18, 24 months have been challenging with everything that's happened, but I think we're coming out of it now with a pretty kind of strong tailwind. So I'm really, really excited for the future of markets in India, and also kind of how the overall kind of participation of individual and retail investors is going to grow from here on here.
Of course, you came into the picture wanting to disrupt the asset management industry. A year on, how much disruption have you caused?
Yeah, look, I think the way I would frame it is not as a big bang disruption, right? Let's be honest here. I call it more a series of micro disruptions that we're looking to do here that over the longer term will lead to a major change. We're pretty happy with the start so far. So just to give you some context, we're just over a year since our launch. We've collected about $2.5 billion in assets. We have 1.2 million retail investors that have come and invested with us. And so far, it's been in a digital direct-only model. So that's a really strong attestation to the power of, firstly, the Jio ecosystem, which is the 50% shareholder here, but also the overall kind of digital adoption here in India, especially in the fintech space, is rapidly increasing. So that's really strong. The other really important stat that I look at is how many people are we bringing into the market. So to give you some context, of these 1.2 million retail investors that have come to us, 20% of our investors are first-time investors into the industry. So they've never really invested in mutual funds before until they bought a JioBlackRock fund. That's really important because our big objective here is to actually grow the market. And the fact that in the first year we've been able to achieve that kind of a percentage is really encouraging. And now, where we are a year in, we've got a lot more broader product set, and we're kind of ready to accelerate from here on.
Interesting to see, right, Sid? I mean, when it comes to BlackRock, it is synonymous with passive investing, but you're getting pretty active in the Indian market. Why is that? What is the thinking?
Yeah, I mean, to be honest, you have to meet the market where the market is. So predominantly, it's still here within the retail space and active equity market. And we felt that with our strategies, we still had something different to offer. There's a lot of asset managers here, all applying more traditional kind of fundamental stock picker type of approach. We felt with BlackRock's systematic active equity franchise that has been running so successfully for 40 years, that's something that we could bring and really offer to India as a new way of investing actively in Indian markets and in equities. So that's the first thing that we brought. But it's not just about active or passive. We've got both. We've got our first set of index funds that we launched late last year. Last week, actually, we listed our first ETF. So now we are active in the ETF market here as well with our Nifty 50 ETF. So for us, really, it's about having the full range of offerings. The index market here is still low. We're at about 18-19% of the total industry. So when you look at Europe, which is over 30%, and US about 50%, right, there's a still long way to go. But it's growing. It's growing rapidly.
You talked about the retail investors in India. They've played a huge role in propping up the sector there. I'm just wondering, do you think retail investors in India are actually taking more risk than they realize after years of elevated returns?
So that's a great question, and I think it's a segmentation question. There, there's definitely a huge participation of retail in the more exotic parts of the market, so futures and options. I'm sure you covered that very extensively here. There are some concerns, both from kind of market players as well as the regulator in terms of how that has been panning out, and you've seen some action taken on that front. On the actual fund side, I don't really think so. The reality is, it's a much younger population here. So the fact that it's more heavily weighted towards equities is natural and probably the right thing as well. And yes, there's been, I would say, over the last 5 years, there has been in the first part of it almost an expectation that I put my money in equities and I make 15, 18, 20, 30% sometimes.
Right.
But that's changed, right? So what's happened in the last sort of 18 months and now coming close to 2 years, it's been more flattish. And the most encouraging sign for me is that that's not like scared the investors away. So there's no rash decision making happening on the fact that, okay, there's been a quieter period in equities. The monthly SIPs, so the systematic investment plans that we talk about here, are still powering the market. There's still about $3.5–4 billion every month coming in through regular systematic investing into the markets here through retail investors.
How about the bond market, Sid? Where on the curve is looking pretty attractive because the rally in the short end reversed recently?
Yeah, so look, I think for us, we are still a bit more leaning towards the short end of the curve. We'd like to see a little bit more of kind of the newer liquidity injection that has come in through the FCNR scheme play out. There's definitely pretty robust credit growth. I'm sure you've seen those numbers. It's about 18%-ish year on year. So there are we're starting to see some positive trends there, but at the moment we're still more on the short end of the curve.
Sid, great stuff. Sid Swaminathan, MD and CEO at JioBlackRock AMC. And Bloomberg has just launched a dedicated digital experience for India. Subscribers can visit bloomberg.com/India for exclusive reporting and curated features, video, and of course, other content from our global newsroom. Do check it out. Still a common insight. As Thailand looks to overhaul its security laws, Stock Exchange President Asadej Kongsiri tells us exclusively how the changes will speed up investigations and boost accountability. Keep it here with us. This is Bloomberg. Welcome back. You're watching Inside. Thai stocks have become some of Asia's quiet winners this year as the tech sector takes leadership. The market has also put corporate scandals behind it as turnover recovers to normal levels. The exchange is now set to take on further challenges with ETFs and overseas listings. Anthony joins us again with a closer look. What a turnaround for this stock exchange.
Yes, Has. Long before the grey hair, I used to be a Thai trader at Goldman, and it makes me really happy to see how well this stock market is doing. It's one of the quiet winners here, beating not only the Singapore's AI-driven rally, but also regional giants like Japan and India. Flip the board and we can see exactly why. There are triple-digit gains in the Thai electronic index, right? So you see all of its microelectronic component sectors are up triple digits, and then you have Delta Electronics up around 48%. This stock is Thailand's biggest stock in a big turnaround in market structure at the top end of the book towards tech. And this sets up Thailand really well in the second half as an AI play, as a supply chain play for the rest of ASEAN, and then the Chinese tech ecosystem as well. Now flip the board and we can see what it's done to turnover. So as Thailand resolves some of its corporate governance issues in 2025, you see turnover materially recover, and actually you see this spike here. That was the AI euphoria around Delta, right? So now going into the back end of this year, the exchange has the challenge of getting new listings around the tech space, also from Chinese companies that are heavy in ASEAN, and rolling out those ETFs you mentioned, whether it's the inverse in ETFs, whether it's leverage ETFs or crypto ETFs that are up for consultation. Let's see what the future brings in terms of the sophistication of the Thai market, but on terms of the fundamentals and the stock performance of the underlying index, it is on a very strong footing.
Anthony, thank you. People tend to forget that Southeast Asian markets are also gaining from the AI play. Well, joining us exclusively now, Asadej Kongsiri, President of the Stock Exchange of Thailand. Asadej, good to have you with us. You know, what a turnaround, massive gains. Are those gains sustainable? Will momentum build for the Stock Exchange of Thailand?
Well, it's been a great year for Thailand, as Anthony mentioned just now. So we've got good momentum. Volumes are back up north of $2 billion a day on average. The market's up almost 30% year to date. And we're working with the government, with regulators, with businesses to really try and continue and push this momentum forward. I think fundamentally, what we're looking at is a stable government that can implement policies that can attract long-term foreign direct investments, that can boost private sector investments as well. So we're seeing that happening right now. Momentum is gaining, and we're looking to push that forward.
I'm just wondering if the rally is supported by fundamentals.
Well, ultimately, what we've seen in the movements, how we've tracked the movements of fund flows this year, the main trigger point that we saw was the result of the elections back in February. That was the real trigger that turned around interest from foreign investors. Today, I'm speaking from our flagship annual event called the Thailand Focus. We've got a great number of investors globally attending this investor conference. We've got 77 companies that are going to have one-on-one meetings to really push the story of Thailand going forward as well.
You talk about momentum. A lot of the emerging economies have benefited from capital reallocation by global funds. To what extent has Thailand benefited from that?
Well, year to date, again, we're for the foreign fund flows, we're up around north of $2 billion at the moment. So there's been a positive fund flow. And interestingly, it's not only into the electronics or AI-related sectors, but we've seen fund flows into fundamental sectors such as financial markets, banking, energy sectors that are strong components of the Thai exchange as well.
What's changed for these foreign funds now that they're back being attracted to Thailand?
I think that ultimately, like I mentioned before, the strength and the continuity of policy being implemented will be the key factor. If you look at the foreign direct investment applications that we've seen, it was a record year last year, but this year, even half year, it's almost surpassing the entire of last year already. And these investments are in sectors like data centers, electronics, high-end electronics, semiconductors, healthcare, manufacturing in the EV space, and so on. So a lot of fund flows are coming on the back of strong interest on fundamental investments as well.
You talk about fund flows, foreign fund flows. So far this year, it amounts to 76 billion baht. If you were to look into the crystal ball, what are you expecting for the rest of the year?
Well, obviously, from an exchange perspective, we're hoping that this will continue. It depends on, again, the fundamentals. If the government can continue to push forward and implement the policies that they've announced, things like there's a policy called Thailand Fast Pass, where we're accelerating from investment applications into real investments, real fund flows in CapEx, in developing the workforce here in Thailand. That will be the great push for Thailand to reach its potential that we all believe in.
Could answer that, even though you've seen a turnaround in Thai stocks versus what we saw back in 2025, the IPO market remains pretty lackluster. So far this year, you've only raised about 350 million, which is a drop in the ocean. And when compared to your peers around the region, it's also been very small. We've had 1.7 billion for Malaysia, 850 million for Singapore. Forget about the Hong Kong Stock Exchange. I mean, it raised $40 billion so far this year. Why has it been so difficult for the Thai market to turn around its IPO space?
I think it takes time. As we all know, that the IPO cycle and process is not a short period. It takes sometimes years, but sometimes at least more than 6 to 9 months to get an IPO going. So at the moment, through this momentum in fund flows and interest in the market generally, going forward, we're seeing a lot more interest from companies to raise capital, to invest. So it's been a laggard, admittedly, relative to other markets. But I believe that it's as a result of the performance of the market overall in the past 3 years. Going forward with this momentum, with this deepening interest in fundamental investments in Thailand, we see a lot more interest, a lot more conversations from our team that would hopefully see a greater number of IPOs, quality IPOs going forward. We're also working very hard with regulators, with the government, to look for new companies and new sectors to come an IPO in Thailand as well.
It is a very competitive space, right? Because all exchanges, especially in this part of the world, are after the same companies. In fact, when we spoke to the Hong Kong Stock Exchange, we had Bonnie Chan saying that she's tied up with the Malaysian Stock Exchange to make it easier for Malaysian companies to list, to IPO in Hong Kong. What are you doing differently? How are you planning to attract more IPOs?
So, for example, one of the regulations that has been recently approved by the Thai SEC is what we call the new economy listing rules, which will make it easier for new businesses that may not yet be profitable, but have a strong pipeline of revenue or plans going forward to be able to list earlier in the Thai market. And we're targeting these regulations towards the foreign direct investment companies that are establishing manufacturing or investment vehicles here in Thailand.
Any clarity how many IPOs will come to market for the rest of the year, and which other companies, countries outside of Thailand might IPO where you are?
Admittedly, it's early days at the moment, so I'd rather not talk about the exact numbers, but our team is talking to quite a number of companies that are investing in Thailand, quite a number of companies that are established here in Thailand already that could potentially look to tap the Thai capital market for capital and for expansion capital.
We know that you've implemented and relaxed IPO rules. Are there concerns that perhaps that could be raising the risks for retail investors in Thailand?
I think the rules will be quite specific in terms of what types of economies and what types of companies can be listed under these new more relaxed regulations, as you say. We're also working with the Board of Investment as well as a partner to see where the government can help support what we call the programs called BOI to IPO. So Board of Investment is BOI. And those will be specific targets, specific companies that obviously have strong businesses abroad already. But
can you meet your
it's
2026?
a good question. It's a balancing.
It is a balancing act. I'm just wondering, in terms of your targets for 2026 to 2028, those strategic goals, will they be met, you think?
Yes, we will always have to target our goals. But so to speak, we don't have a specific number targets for IPOs. It's always a difficult question and always tough to balancing quality versus quantity. From my perspective, personally, we're looking more for quality to protect investors as well.
What do you make of the outlook for trading activity? We've seen a sharp increase in that. Is that sustainable?
We hope so. I think as long as the Thailand story continues to be pushed forward, actions are being seen by the government in terms of policies implementation. We know that the government is working with the private sector to, quote unquote, have a Thailand growth story that we can inform the investors universe around the world. If that can be continued to be pushed forward and communications continue, we do believe that positive momentum will continue in terms of fund flows and businesses.
But in terms of catalysts that could drive the Thai stock market higher for the rest of the year, what would be the key ones?
I think ultimately, we hope to see some additional clarity on government policies, government implementation of specific long-term policies. We want to see numbers that are coming out of this, what I call Thailand Fast Pass, how the number of investment applications that can be converted into real fund flow, into real monetary investments here in Thailand. I think that will be the key in driving the direction and the sentiment going forward.
And how about in terms of the biggest risk for the market?
I think there's always continued volatility around the world. Obviously, the continued high energy prices will potentially have an impact. But again, this is an impact all around the world. Today at the Thailand Focus, we will actually have on stage the Minister of Energy coming out to describe policies of how they will convert these potential risks into opportunities for Thailand. So, for example, there's a lot of interest in data center investments in Thailand. Data centers are looking for clean energy, which Thailand has the potential to provide in abundance, as an example.
Asadej, how closely are you watching the surging yields in the U.S.? Some say that if yields continue to surge, then the stock market might be impacted. Do you see any spillover effects for Thailand and the rest of Southeast Asia?
It's something that we're always keeping a close eye on, and how that will impact the market generally. I think it's something that our economists will continue to keep track of. But if the fundamental stories of Thailand can continue to be pushed forward, and the stability of the Thai stocks or Thai businesses, investors might see Thailand as a safe haven.
Good, Asadej. Thank you so much for your time. Asadej Kongsiri, President of the Stock Exchange of Thailand. And we have breaking news out of Indonesia. We have the government saying that Destri will serve the full 5-year term as Bank Indonesia governor. Of course, we had that surprising stepping down of Wargio, and Destri was put in place, but now she has been confirmed for a 5-year term. And before we go, here's a look at tomorrow's show. Philippine Stock Exchange CEO Ramon Monzon will be with us exclusively to discuss the upcoming reforms, including plans to raise minimum capital requirements for stockbrokers. And Sarita Singh of online payment company Stripe will be taking us through the company's multi-billion-dollar expansion into AI infrastructure. And that is it for Insight. Horizons Middle East and Africa is up next. Keep it here with us. This is Bloomberg.